GM. Today's daily lesson. I'm going to talk about the cycles of emotion at a late stage rally. So, what happens as we get closer and closer to the end of a rally is that panic sets in, but it sets in the opposite way. Panic does not mean the markets go down. You can have panic buying or panic selling. Panic selling happens in a bear market. It doesn't happen in a bull market. Nobody panic sells in a bull market. They are forced to sell. And nobody panic buys in a bear market. They are forced to buy. So when you see a bear market rally, the characteristic of a bear market rally is we grind down and down and down, and people progressively get more and more bearish and eventually panic. So if you imagine Bitcoin, it goes down from 40. People feel a bit, I bought it at 50, it's now at 40. They feel a little bit of tension, a little bit of anxiety, right? But they're kind of hoping it's going to bounce. Then it goes to 35, and they start to feel worse. Then it goes to 30, and they're like, if it holds 30, I'll be fine. Then it dips to 28, and they panic and sell. Because it goes down and down slowly, step, step, step. Then it drops a little bit, they panic, it reverses, and then it squeezes. It's a short squeeze. That's why a bear market rally is always almost just straight up, right? Doesn't let anybody on board. And then when it runs out of steam, it doesn't find any support and it just retraces all the way back. So it might rip then from 28 all the way up to 40, all in one go, and then slowly bleed out and just fall back, find no support, and be bearish. So that's a bear market rally. The panic is characterized on the way down. Now everybody, once you get into a bull market, is late to change their mind. They're still stuck in bear market mindset. So what you see then is slowly their mind changes. So at the beginning, this is why you have a disbelief rally. This is why at the beginning of a bull market, everyone's questioning whether it is. They're waiting for it to fail. This rally will fail like all the others. You've seen the Wall Street cheat sheet. And what it does is it makes people very, very cautious when they should actually be taking on risk. So the time to be adding your positions is when you don't feel like it. But of course, most people don't, and the dumb money always lose money. So what happens is price goes up and up and up. Just the same way, if you look at any of the charts over the past few weeks, they've gone up in the same fashion that the market went down in 2022. Where it goes up, sideways, up, sideways. It's kind of stepping up. It's not all crazy, massive pumps. Then we're now reaching the stage where it's really accelerating. This is the panic buying stage. The panic selling that happens in a bear market is because people think I need to get out now because it's going to go lower and I don't want to take this pain anymore and I have to stop. I have to get out. I have to be out of the market. I have to be in cash. I can't bear to see it go from 40 to 30 to 28. The panic buying happens because of FOMO. The fear of missing out creates panic because they think if I don't get on now, I'm going to miss the big move. So even though Solana's gone from 25 to 35 to 45 to 55 and they've done nothing, suddenly when it blasts off above 60, they panic and think I need to get on now because it's not going to stop. So a key characteristic of what you know as FOMO, fear of missing out, is panic. And so the panic buying is FOMO. Nobody considers selling here. Just like nobody considers buying in a bear market. When I say nobody, I'm talking about dumb money. Nobody wants to buy in the bear market because either they think, no, it's looking bad, I'm going to wait until things feel safe, or they say, I'm going to buy much, much lower. And of course, that much, much lower target never comes, and they end up buying when it's way too late, and we've already had the first significant bull trend. So they won't buy willingly in a bear market. They get forced to buy through a short squeeze, any shorts that were involved. And in a bull market, people will not sell willingly. They will only sell when they're forced to. But they will willingly, happily buy any bounce, any pump, any breakout, any new highs after they feel like it is safe. Meaning, oh, the market's up so much that it must now be a bull market. And yes, directionally, they can be correct. So right now, November 2023, Solana's up a lot, Link's up a lot, Bitcoin's up a lot. I think the bear market's over, absolutely. I think the bottom's in, absolutely. But does buying here make sense? No. Because it's not about the price, it's about the psychology. Why are you buying here? Why didn't you have a plan to buy lower? If you didn't have a plan to buy lower, buying now is clearly an emotional reaction. It's literally saying, I know I don't have a plan, but if it keeps going up, I will feel bad, so I must get in. That's FOMO. You're destined to fail if you give in to that emotion. So how should you actually play this? The way to understand it, and why a few days ago there was a sharp leverage dip, took Solana down 15%, took Arbitrum down 20% plus, and I bought a little bit of Solana and traded it up, is because, not because I can see the future, but because in a bullish market, in a strong uptrend, eventually leverage will come in. People will just start to FOMO in and get long with leverage. So when you see a really fast, sharp drop in a bullish trend, that doesn't like entirely break the market, right? If it went down 40% in one candle, that's probably too far. But if it drops 10, 15, 20% and has a decent rebound, that's a sign that the panic buyers from the previous pump have been taken out. And then what's actually most likely is that the market will bounce because the leverage is flushed. The smart money will step in. They will buy. They will run it back up again above those highs so that the panic buyers can come in again. This is the cycle. This is how it repeats. Also, you have to remember that in a bull market, resistance is weaker. The market wants to make new highs. And it's always the early stage of bull where people play this wrong, because their mindset is based upon a bear market where every time price reaches resistance, it usually fails, because a literal definition of a bear market is lower lows and lower highs. So when you get a bear market rally, it should stop before a new high. But the complete inverse is true in an early bull and, of course, a full bull, meaning you expect resistance to break. Do not look at resistance in a bull market and say, here's where I should sell. No, you should sell above resistance, not below it. Right? Again, the conventional wisdom is always wrong. So if price is coming to a key resistance, but you're in a bullish market, expect that to break. Because when you think about it, when you zoom out, when you go to your line chart, you take off the candles and the wicks, how do markets move up? They go higher high, higher low. So if it's coming to a previous high, expect that to break. If the high is 58, expect it to go to 70 and then come back and then form a low that is higher than the previous low, because that is how the market works. So what you want to be concerned about in terms of is the trend ending is not fast, sharp leverage dips. They're actually quite bullish. Not every single time, but probabilistically, buying after a 20% correction in a bull market rally is good. Is positive EV, let's say. But go and back test it. Don't just take my word for it. The time you want to be concerned is when the market rallies really hard, has a little bit of a drop off, and then starts to consolidate, goes sideways or down, and sort of stair steps down. You don't really want to see slow, sustained pullbacks on altcoins after a big accelerated trend, like a blow off top, a big pump on the 4 hour, on the 1 hour, on the daily, or whatever. Because that's more of a sign of distribution. Remember, to keep the market rallying, to keep it going higher, they should flush. You should flush out the leverage, force people to sell so that smart money can take the other side of that trade and buy, because liquidity, you have to have a buyer and a seller. If there's not enough sellers because the market's so bullish, they will create sellers by forcing them down on leverage. But if it goes step, 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 that's actually a sign that the selling is very controlled. If there's controlled selling, it is not emotional. It's not dumb money, right? Controlled, slow selling is not dumb. It's quite smart. So you want to either wait for some kind of emotional spike at the bottom, right? So step, 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 then a big spike down that shows the leverage has been taken out. Or you want to just avoid entirely and wait for that distribution to play out, because that's probably the end of whatever trend it is, and the market's going to go into a consolidation, and it does that because The market trends about 20% of the time, and it consolidates about 80% of the time. So the vast majority of what we see is not trending. But of course, as the trend accelerates, people get more and more into the mindset of, oh, this is a trending market, and that's where they fuck themselves up. So take that, understand it. It will absolutely enlighten you, open your eyes, and help you to understand the psychology of trends. Big, fast, sharp, scary leverage liquidations are good if price obviously finds a bottom and holds. Slow steps down after a massive uptrend are not good. Just play with that rule, stick with it, and that will help you.